All right, guys, welcome back from the exam. So now today we're going to be taking a look at chapter 7, okay? Chapter 7 is broken into 6 sections, which because we've learned what periodic inventory looks like, okay? This part's going to go by very, very easily because we've been exposed to this type of concept before, except this time we're not looking at periodic inventory, we're looking at perpetual inventory, okay? So as I've mentioned before, we're looking at the standpoint of a merchandising inventory, right? Or a merchandising type of business activity. So our concept here is that we're going to purchase inventory, okay, with some kind of form of money. All right, we're going to convert that into goods, right? We're going to convert cash into goods, and then we're going to convert the goods into sales, and then ultimately our goal is to turn sales back into cash. Okay? So once again, what is included into inventory? Exactly what we learned in chapter 5. All right? And then everything here, right, is the same idea, right? We're still going to be focusing that when we make purchases of inventory, right, we're treating it as an overall amount of how much it's going to cost me to get the asset to my store, all right? If there's shipping and handling, if there's tax involved, if there's foreign fees, if there's even storage fees, right? All of those are going to be considered as part of the cost to get your asset to the store, all right? And of course, now we're looking at the 2 different tracking methods. Now, chapter 5 and chapter 6 was dealing with periodic inventory. So for now, what I want you to do is I want you to get everything that we learned in chapter 5 and chapter 6, and I want you to put it aside, okay? Because right now, we're going to be pulling similar ideas from chapter 5 and chapter 6, but chapter 7 and chapter 8 is going to be dealing with perpetual inventory, all right? So as we've been exposed, okay, a little bit and been introduced to perpetual inventory, we understand that the definition of perpetual inventory is constantly. So when we have the idea where we're constantly updating our inventory, we're constantly going to be, every purchase that we make, we're going to update our inventory. Every sale that we make, we're going to constantly update our inventory. So in this case, right, you can, the way that we keep track of it, if you're constantly updating your inventory, whether it's on a daily, weekly, bi-weekly, or even monthly basis, you will know how much you should have in your inventory at all times, okay? Because you're keeping it tracked that way, right? Every purchase that you make of inventory, you're going to update your inventory. Every sale that you make, you're going to take it out from inventory, all right? And the huge, huge, huge difference between periodic inventory and perpetual inventory is that when we actually make purchases of inventory, we're going to automatically treat it as inventory already. So when we record the purchases of inventory, we're going to put everything into inventory, okay? We're not going to recognize it as an expense and then convert it into inventory at the end of the month. In this case, I'm already validating this as inventory. I'm going to be updating it left and right, right? By, obviously, every time I purchase it, and then every time I sell something, I'm going to be constantly updating my inventory. So in this idea, we're going to treat our purchases of inventory as inventory. And every cost that's associated with that inventory, you're going to put it all into inventory, okay? So the main idea here is that when we're looking at perpetual inventory, inventory. Where did you place it? Inventory. Where did you sell it from? Inventory. Where you take it out from? Inventory. Okay? So let's go ahead and dive right into our first example, right? Actually journalizing the purchase of inventory. So in this case, right, we have here that on July 1st, XYZ company purchases 100 toys that costs $5.65 each, okay, from Toys U. All right, freight here is going to be considered as $100, all right? And so the question here is, I want you to be able to record or journalize this transaction. Now, since we're treating our purchases and we're dropping them all into inventory, right? In this case, I specified exactly what I bought. What did I buy?
Toys.
You bought toys. So in this case, right, everything's going to go into inventory. In this case, my inventory is toys, right? Inventory is just the main account, right? I can sell toys, bikes. I can sell anything. So in this case, I want to break down my inventory account to more specific items such as toys. So in this case, I'm going to refer my inventory as toys. And because, like I've mentioned before, right, my purchase is going to go into there. Every single cost that's associated to my inventory is all going to go into inventory. Okay? So in this case, with that kind of idea, how am I going to journalize my journal? Any guesses?
It'd be toys.
It'd be toys, good. For what amount?
Okay, 5 times for 5.6, 5 times 100.
In this case, it's 100 times 565, okay?
Yeah,
So you think it's 565?
plus the freight cost.
Plus the freight cost. Excellent. So in this case, right, the idea is that we're going to put the purchases in inventory. And every cost that's associated to it is also going to go directly into inventory. So in this case, right, my inventory is toys. And what I'm going to do is I'm going to shove everything into inventory. So my total cost here is going to be $665 because that includes my purchase price plus my freight because they're all going to go into the same account. Okay, so this is perpetual inventory. Any questions? No?
So, in essence, you don't separate any other cost as freight or whatever other stuff. Everything just goes in that amount.
Yes, in this account, yes, because in this case, I'm not recognizing it as an expense. So there's no need for me to separate my expenses. In this case, all my costs that are going to be associated to perpetual inventory is just going to go all directly into one account. So in this case, right, I'm recognizing I'm purchasing toys. So every cost it takes me to get this to my store is all going to be into the same account. So no, there's no need to separate any of those expenses or separate any of those things because you don't need to do that. In this case, we're shoving them all into inventory.
Okay, thank you.
Mm-hmm. Well, that was section 7.1 for you. All right, easy as that, right? So in this case, right, the difference between periodic and perpetual is this right here, right? Periodic, we recognize them as expenses. Here, we're just going to recognize them all going into inventory, just like that. That's the difference between periodic, and perpetual, right? And that's just making the purchases. Okay. But of course, right, if we have the idea where we can make purchases, we can also make purchase returns and allowances, because we have the idea that sometimes the vendor, they may ship things to us, and when we open up the boxes of inventory, we can recognize that some things could be damaged, defective, okay, broken, or maybe there's a cheaper person that sells the same exact product to you with the same quality, right? Or just customer service itself. If they've been sending you the wrong stuff every single time, at this point you could, cut ties with them and say, hey, I want a full refund, or I want a return, okay? And of course, with that idea, right, our vendors wants to keep the relationships with us because, we're purchasing them in large batches or large quantities, right? We could easily purchase thousands of units from them. So we are primarily going to be a customer that purchases a lot from them. So they want to make sure that they can guarantee, especially because this is their product that they either manufactured and that they're selling out to us. They want to keep our business. So best way that they could do it is to either offer us discounted prices, 100% money back guaranteed, unlimited amount of refunds, etc., etc., right? We understand that when we make a return to our vendors, they're willing to accept everything, or willing to make sure they keep our service, right? So in this case, let's go ahead and re-practice this again. So we're going to look at purchasing. You need to make a purchase before you can actually return items. So in this case, right, on January 1st, okay, you purchased 100 coffee mugs, okay, on an account from Cuppies Co., okay, costing you $1.25 each, with the freight costing you $100. Record this transaction, okay? So here, what do you guys think my journal should look like?
January 1st, inventory for 225. No, because you purchased on an account, correct?
Mm-hmm. So you got the first portion, inventory, okay? Now, how much is going to be my inventory?
It's 125 for the mugs plus the $100 for the freight, so the total is 225.
Perfect, right? Because in this case, everything's going to go into inventory. So in this case, I specified exactly what I'm buying. So I should refer it right here as coffee mugs, right? And exactly how you explained it, right? Everything's going into inventory. So therefore, my purchase price plus my freight is going to go all into inventory for $225. So then, let's just say for this scenario, okay, so then on January 5th, you received your inventory and found that 10 of those coffee mugs were broken, okay, and you requested for a full refund, okay, for the broken mugs. Okay, and the vendor, of course, grants you full refund. So how are you going to record this transaction? Okay. In this case, I'll give you a big hint. You do not need to create any contra accounts for this. Okay. So in this case, right, I'm requesting for a full refund. Okay.
Would you debit accounts payable for $12.50 and then credit inventory for $12.50?
Correct, right? Because in this idea, right, where did I place all of my inventory? Straightforward. I placed them into inventory. So in this case, inventory can be increased and decreased. Right? Exactly right. That's exactly right. Because we placed, because we placed it into inventory, there's only one place to go or one place to take it out. And because since we recognize it as coffee mugs, I'm going to directly take it out from coffee mugs. And if my coffee mugs cost me $1.25, right, we can't return freight. So therefore, 10 times $1.25 does give you $12.50. And that's exactly correct. No having to deal with any contra accounts because we know exactly where my inventory items are. So in this case, if we have the concept, everything is going to go into inventory. Therefore, everything that you take out is going to be directly out from inventory. All right? Any questions here?
No.
Okay, so now let's practice the allowance part. So the first one was a full return, right? So now let's also understand this one. So then on January 5th, okay, you received your items, okay, and found that 25 of those coffee mugs were the wrong size, okay? And then, of course, you requested for a refund for the extra large coffee mugs, okay? But the vendor somehow convinced you and offered you a 20% discount and you accept it. So in this case, how are we going to journalize this transaction this time? So now we're getting an allowance, right? Because the vendor decided to ship us the wrong cups or the wrong size, but somehow convinced us that, hey, to reprimand our mistake, we'll give you a 20% discount off of the 25 extra large coffee mugs. So in this case, how am I going to journalize this?
It's a refund, so you're going to debit accounts payable and credit inventory.
That's exactly correct, right? If everything goes into inventory, everything's going to be taken directly out from inventory. So exact same concept, right? Except this time I'm only getting a 20% discount off of the 25 mugs that I'm returning, right? Or trying to return. So in this case, 25 times $1.25 gives you 31.25, which 20% of that gives you $6.25, and we take it directly out from my inventory. And that's it. Easy. All right? Any questions for returns and allowances? All right? Everything that goes into inventory, you're going to automatically take it out directly from inventory. Okay? So then, of course, when we talked about purchase returns and allowances, right, we also have to take a look at what happens when there's purchase discounts. Okay? So once again, we've seen this before, terms, right? We understand what 2% 15 net 30 means, right? You'll take a 2% discount if you pay within 15 days. If not, the whole bill is due in 30, right? We understand that. So here we're taking a look at what happens when we're dealing with the net method versus the gross method, which we have seen this before. But this time, right, instead of journalizing it as a purchase expense, we're going to journalize it as inventory. So in this case, same idea here, except of course, the way we journalize perpetual inventory is the difference between, it's the difference, okay? So once again, we're going to take a look at net method, which means when we take a look at the discount, right, we're really good at paying our bills on time. So we're automatically going to pretend that the discount is going to apply automatically and that when we pay them on time and that we're going to get the discount no matter what. So in this case, we're just trying to save ourselves another journal. Whereas the gross method, right, is for more smaller kind of businesses who, are not quite sure if they can pay it right then and there to get the discount, right? Because they might have other priorities that they have to pay for first. So in this kind of concept, right, we're going to journalize it as is, and whenever we pay for it, and if we make it within terms, then we have to discount our amount, okay? But in this case, all right, the net means you take the discount immediately. Gross, you're going to take it later. Okay? So let's go ahead and take a look at net method first, just because we already know what gross method looks like. So net method, right? So here's an example on February 1st, okay, that you made a purchase of 100 coffee mugs, okay, on an account at Cuppies Co., which each cup costs you $1.25 each, with the freight costing you $100. Terms are 5%, 10, net 30. So how am I going to record this transaction?
It's going to be coffee mugs for 225.
Okay, so remember. Good. Okay, so coffee mugs is correct. And you said 225 minus.
You said on net method we're going to be paying on the terms, correct?
Yes, right? We're going to take the discount immediately.
Okay, did I get this correct? 5% is 1125 on the 225?
Uh,
That's 1125, right?
let's see, 125. Okay, so you said 225. What does 225 include?
Oh, never mind. Yes. Includes the freight, so it should be 125. 25. Not
Correct. Yes, 5% of 125. Good. So what is 5% of 12 of sorry, what is
625.
625? Good. So then in this case, what is going to be my grand total?
118.75.
Plus my freight?
So it's 218.75.
Excellent. So here we go. We recognize that we're going to place everything into inventory, right? We're going to do exactly what we just did, right? We're going to take my 100 items times by the 125 to get me a total of 125. Since I'm going to take my discount off immediately, I'm going to recognize my discount now. So in this case, I'm going to take my 125, multiply by my 5%, which gives me 625, which I'm going to take that right away off of my 125. Then I add my freight to give me a grand total of 218.75. Okay? Excellent. So then, right, now here is where I'm going to make a payment, right? So scenario 1. All right, it is now February 9th, okay? And we decided to pay Cuppy's Co. with a check, okay, for the purchases that we made. So in this case, reminder, terms was 5%, 10, net 30, all right? So in this case, we've made our terms, right? Because we purchased the items on February 1st. This time I'm paying as of February 9. So in this case, I made my discount. However, I've already discounted my items. So in this case, I'm just going to recognize I'm making a payment for my discounted cups automatically. Okay? Just exactly how I've already journalized it. But let's say scenario 2, I realize that it is now February 15th and I just missed my discount period, okay? So therefore, I have to pay in full. So in this case, right, because I originally journalized it as my discounted amount, but in this case, I missed my discount period, so I have to pay in full. So how am I going to recognize this journal? How am I going to add back that discount? Where am I going to add it back to? Right? If everything goes into inventory, right, and I forgot and I missed this payment, my only place I could place it back into is right back into my inventory. Okay? Because if I took it out from my inventory in the first place, therefore, I need to place it back into inventory. All right? Which we already know was the $6.25. And here, we're going to make a full payment for the $225. Okay? All right, so that's net method. All right, gross method, same thing here, except we're going to journalize it at original full price, which we know to be $225, right? And of course, when the first day, so here on February 9, we made the discount period, right? So in this case, if we made the discount period, that means we're going to be making a less payment. So in this case, what I'm going to do is I'm going to take the discount directly out of my inventory. And because I made it within terms, I'm paying within the first 10 days. Therefore, I'm going to take the discount off of my inventory immediately, and therefore writing a check for less. I'm writing it $6.25 less. And I'm going to discount that out from my inventory because I didn't pay $225. I only paid $218. So therefore, in my original purchase, I've recognized that it is $225 when it's actually only supposed to be $218. Okay? All right? And of course, if you paid after the discount date, you just pay for the full amount. Simple and easy as that, right? You just pay for the full amount. No discount is taken out or anything like that. Okay? Any questions for chapter 7.3? Okay. Chapter review once again. We're taking a look at perpetual inventory, right? And the way that we journalize perpetual inventory is we're going to recognize the actual item that we're purchasing, right? Or if I don't specify, it's going to go straight to inventory. And that's the idea here, is that we're just going to put everything into inventory, just like that. Okay. We also talked about returns and allowances. So once again, if I'm I have to make a purchase first, but when I return the item, it's going to come directly out from my inventory. If I get an allowance, it's still going to come directly out from my inventory. Okay? And of course, my net versus my gross method for discounts, same idea here, right? Except for the net method, right? We're going to take the discount out from my inventory automatically in the very first journal. And then when we pay, we either pay for the amount, but if we missed it, then we have to add it right back into my inventory. So the idea here is pretty straightforward, very simple, very easy, right? If the idea is that when we make purchases of inventory, every cost that's associated with that purchase of inventory is going to go all straight into inventory, right? Any returns, discounts, allowances is going to be taken directly out from inventory. And that is it. Simple as that. Okay. So, right now, it is close to 10:15. So I'm actually going to call break now. And then when we come back from the break, we'll go ahead and do the first exercises, and then we'll go from there, okay?